What's going on? Welcome back to Trending Stocks. Today when I talk to you about SoFi. Holy hell, is it on a tear today? I want to go over some of the current data points, break it down what shorts are doing, and go over everything else that you need to know. But first, make sure to hit that thumbs up. And with that, let's get right to it. Starting off, SoFi is up 3.29%. So round of applause. It did successfully get above that $7 mark. Couple different attributing factors though. One is CPI. So CPI came in a little bit lower than the forecast, both on a year over year and as well as a month over month. So that's what gave it a nice bump up pre-market and then as well as soon as the market did open. And then secondly, you kind of had a pullback a little bit. That's because people started to look at the true data, saw that the energy basket is down about 2%. So meaning the other basket items did go up. So it's not necessarily the best, but still at least moving in the right direction. So again, that's kind of why a lot of stocks and the broader market has kind of kept its gains. Second thing for SoFi is you had Chris with this fireside chat. So I'm going to play this. It's around, it looks like 26 minutes. I'm going to play this near the tail end of the video in case you did miss this. But Chris once again hits a home run, so I'll kind of save the spoilers for this in case you guys haven't listened to it. And then third point, yes, a third point, there's a ton of crap coming out today, or positive stuff, I guess, but there was Powell, so no interest rate change. I think that was the forecast, but more specifically, it looks like there is at least going to be one rate cut so far in 2024. So based on this, 7 of the 19 officials did see at least one cut in 2024. 8 did see 2 cuts, so still somewhat good stuff for that. And then looks like 4 of the 19 did see no rate cuts. So clearly just very undecided among all that. And based on the September, you did see this jump from about 40 to now 61.5% for a 25 basis point cut. So generally speaking, very good stuff. And this has gone up a little bit more. So I think it went down to about 3. So now it is at 5.6% of a likelihood for the September meeting for a 50 basis point cut. So I think no matter what, the market is somewhat free and clear now to move higher. I think Powell is still doing his speech right now. So unless he comes out with something absolutely crazy to shock the broader market, I think we should be relatively good today. One interesting point is that shorts are somewhat squeezing. Take that kind of with a grain of salt. Right now, shorts are returning about 598,000 shares. 17.4% of the free float is being shorted. Cost of our average is 1.06. And just to kind of show you right here, Vortex is glitching, so I don't know if it's going to last all that long. But as soon as the market did open, this is where you saw them return about 2 million or 2.1 million shares. So that's what aided in it going up as soon as the market did open. So pretty good stuff when it comes down to that. I do believe that they've actually disclosed to the NASDAQ a new position. So I think it's around 18%. So Vortex will update that fairly soon. So tomorrow's video will have a new short interest number. Right now, options wise, 6.42 million in calls, 1.7 million in puts. A lot of money is getting into SoFi through options. So overall, that's a good thing. And you do see of the sentiment though, 46% of all of it is bullish and optimistic. And going over to this wall. So previously, I think when I did my yesterday video, it was pretty much at this 41,000. So there hasn't been any change. So 41,000 at that 7, then 26 at that 750. This has gone up quite a lot, in fact, so the 750. So that might be the next wall that SoFi might kind of struggle with. We'll just have to wait and see. But if SoFi is able to successfully close above $7 by the end of this Friday, you're going to see the market makers go out onto the market and buy roughly around 4.1 million shares just attributed to that. So pretty good stuff if you ask me. Big money was massively getting into SoFi. So you kind of saw that over the last several trading days, not just with SoFi, but across the board, just more of a people holding their breath, waiting for today with CPI, as well as what the Feds are going to be saying after their interest rate decision. And it looks like broader market and large institutions really do like that. So 4.07 million, a couple big ones, and then 1.66 million. So big money is buying the dip. And this is one thing that I did say that was going to happen with SoFi is once CPI did come out, you're going to see institutions get the green thumb or rubber stamp for it to kind of go higher. So Elliott Wave Technicals, as I did bring up, is indicating for SoFi to hit that $8 range. So there still is more room for SoFi in theory to go up. So something to kind of keep in mind. Right now with it sitting at at $7.21. It is trading between this pivot and this R1, so just watch for this 706 to hold. Vice versa, 744 is going to be that next strong resistance / target, which with today's high being $7.43, it did bounce off of this R1. So we know that this R1 is a very strong resistance level. So let me know your thoughts on that. And when it comes down to a lot of the data points prior to me kind of playing this part right here, so the Mizuho technology conference where Chris talks, again, that's 26 minutes. I'm going to play that near the tail and very end of the video, but I just want to play a couple minutes from this because it does talk on a lot of the CPI data and how that is, at least Wall Street is interpreting that. No, my fault guys. I did not have the sound.
The number flat. It was much lighter than expected. But our next guest says it's not the Goldilocks scenario necessarily, as needs inflation, as it's called, remains sticky. And he says that'll slow down the consumer and the economy more broadly. But Powell and company may disregard it as they focus on their so-called super core targets. Joining me now is Jake Obina. He's senior U.S. economist at Piper Sandler. Jake, it's great to have you here. I think this is really important to mention. Welcome.
Hey, Kelly, nice to see you.
So explain what's going on. The things that people have to buy is running at what inflation rate versus the things that they might prefer or want to buy?
Yeah, so if you took a holistic view of inflation, I think there's no doubt that we've seen some significant progress, right? I mean, if you take the shelter component out, which everybody knows has all kinds of problems lagging actual rents in the market, and inflation's right around the Fed target, it's 2. But when you look beneath the surface, the stickiness in inflation is in these parts of consumption that the consumer can't really diversify away from. So it's in healthcare related areas, whether that's services, prescription drugs, insurance, it's in auto insurance, it's in housing insurance. It's in just a plethora of things that make up the consumer basket that are about 25% of consumption that, again, you can't diversify away from. And if you look at that basket, it's running at about 6% year over year, even after today's kind of lighter number.
Wow.
That's a couple of things, right? It's putting pressure on discretionary consumption because it squeezes consumer pocketbooks, essentially. And so it reduces the amount of money that's available to spend on other things. And if you see the transmission mechanism from that sticky inflation to the discretionary parts of consumption, discretionary inflation is all the way down to 0. It printed 0.1% year over year.
It was 0.
In the May report. Yep.
Okay.
0.1. And if you look within pockets, some of them are running negative, right? So I think, this squeeze on consumers from very elevated non-discretionary is having a feedback loop effect to discretionary pricing power in a negative way.
Yeah, I mean,
So yeah, there you have it. A little bit further of a deeper dive than what I kind of mentioned associated to CPI. But of course, so for face value, yes, it's at least moving in the right direction. There is still some lagging aspects, such as what he did bring up. So let me know your thoughts on that. And then with all that said, I'm just going to quickly bounce over to the conference and let Chris speak. So if you guys have already listened to this, then you guys can obviously tune out. But I appreciate all of you guys watching. Don't forget to hit that thumbs up and give yourself a shout out if you did buy today, or did you take advantage and sell, and did you do options? I know when it was at its peak, I was very tempted to sell some 750 calls, but I think given the momentum of today, it clearly shows that it wants to at least get above that Elliott wave technicals. So there still might be some meat on the bone, if that makes sense, for it to move higher. So let me know your thoughts. With all that, I appreciate all of you watching.
Test.
Okay.
Can you hear me too?
Yes. You hear us? Okay. Well, should we start?
Let's do it.
Morning. I am Dan Delev. I am the research analyst here covering payments and IT services. Not alone. Sean covers IT services with me. And I am very pleased to have Chris Lapointe, the CFO of SoFi, with me, my friend. And Chris joined SoFi from Uber. Oh, I didn't know that. Where he was a global head of FP&A, corporate finance, and fintech prior to Uber. Chris was vice president, TMT investment banking at Goldman Sachs. So thank you, Chris, for joining. It's going to be very interesting.
Good Thanks for having me, Dan. Really appreciate it.
Yeah, of course. So, all right. So we have about 24 minutes for questions. So, SoFi's been very successful in executing a challenging and constantly changing macro backdrop of as a public company. Can you give us a little bit of background about SoFi's progress since becoming a public company, maybe some pre-bank charter and post-bank charter kind of examples and where are we today in that journey? So
yeah, absolutely. So what I would say is we set out to create SoFi as a one-stop shop for financial services, and our business has evolved dramatically over the course of the last 4 to 5 years since before we became public. We have a much more diverse product set, and our revenue base shows that. We're taking share in virtually every single product in which we're operating. We've consistently grown our top line revenue and member and product base quite meaningfully over the course of the last 4 to 5 years. We reached GAAP profitability, and we have a very, very robust balance sheet. Now when stepping back and thinking about what got us here in the journey that we've taken, there are a few key milestones that I would point out. First, if you look back to 2020 and 2021, we raised $3.6 billion of capital through our IPO, through our private round with T. Rowe Price, and through our large $1.2 billion 0% convertible note offering that we did. That provided us with ample capital to continue to grow our member base and to invest quite meaningfully in our financial services businesses. The second key milestone was getting our bank charter in 2022. If we rewind back to 2018, 2019, 2020, we were forced to turn over the balance sheet 4 to 5 times a year because we were constrained and limited by the amount of equity capital that we had on our balance sheet, as well as the access to our warehouse capacity that we had. So we were turning over the balance sheet quite frequently and selling loans much more quickly than we otherwise wanted to. What the bank provided us was a low-cost, sticky funding source. 90% of our member deposits today are coming from direct deposit members. And that's provided us with the ability not only to get great interest expense savings, we're saving about $500 million of interest expenses annually today as a result of having that lower cost funding and not having to rely solely on warehouse funding. But it's also allowed us to hold on to loans for a longer period of time on our balance sheet and realize the true economic benefit of that asset base. So we're really happy and excited that we were able to get the bank charter when we did. It has provided a tremendous amount of competitive differentiation for us. The third key milestone was acquiring our Technisys and Galileo businesses, which collectively are our tech platform, and we aspire to be the AWS of fintech. That product offering is as diverse as our consumer offering. And it helps serve large financial institutions who are looking to modernize their tech stack or modernize their payment processing, or larger brands who are looking to get into financial services. And we're, kind of at the core and one of the few providers that are able to provide those types of services in a cloud-based and dynamic way. And then the fourth milestone I would call out is the fact that we became profitable in our financial services segment recently. If you look back prior to 2023, that business collectively was funded by our lending and tech platform business in order to scale. We're now generating $600 million annually of revenue. That business is expected to grow over 75% in 2024, and we're delivering 25% contribution margins in that business. So self-sustaining and growing quite meaningfully. So if you put all of those milestones and facts together, we feel like we have all of the ingredients to become a top 10 financial institution, and we're really proud of the progress that we've made over the course of the last 4 to 5 years.
Well, you definitely have my money.
I love it.
I'm going all the way. So just really quick, maybe we can just jump into you provided long-term guidance for 26. And maybe we can parse out a little bit to the components of the guidance. So if we can talk about the tech platform, you're talking about the mid-20s CAGR through 2026. Mm-hmm. And, how do you expect to achieve this growth? And then what are what kind of clients are coming off for to you from that Galileo Technisys offering? So how do you, and then we can maybe talk about financial services and GAAP EPS. So let's maybe parse them out one by one.
Perfect. Yeah. So I'll hit on tech platform first. So what I would say is why we're confident in our guide and what we expect in terms of the mid-20s% growth is We have a large installed base of customers that are growing quite nicely already today, over 150 million accounts on the Galileo platform. We have dozens of customers that are in various stages of integration or in early stages of revenue monetization that you could expect to see continued momentum and growth over the course of this next several quarters and years. And then, as we've talked about over the course of the last several quarters, we're targeting partners that are large financial institutions who need to modernize their tech stack, or large brands that have big install bases who want to get into financial services. On the latter part, we're seeing very robust demand and are in great conversations with a number of top banks in the U.S. and top banks in Latin America. I think part of that is a function of obviously our product offering and differentiation, but what you're seeing in the broader banking sector of the severe need for these financial institutions to have much better real-time visibility into managing their assets and liabilities. And as importantly, they need all of their products to work better when they're used together. So we're in a prime position to be able to offer that type of solution. We're in RFPs discussions with many of the top U.S. banks right now. Those conversations are going extremely well. Obviously, as we're focused on larger customers that have more durable revenue potential for us down the road, the sales cycle is a little bit longer. It can take 1 to 3 quarters to sign up a client. Then integration takes longer than that, and then you start generating revenue. But what I would say is, with these larger, more established businesses, we're getting to meaningful scale of revenue much faster than we used to when we were focused primarily on neobanks and fintech. So very robust demand. We're really excited about the opportunity ahead of us and a very large installed base that's growing nicely.
And you mentioned GAAP EPS. Obviously, that's a huge achievement. I think 55 to 80 cents in GAAP EPS in 26. Like, what are the main levers that you can pull to ensure that you're, meeting or beating those expectations?
Yeah, absolutely. So in terms of GAAP EPS, what gives us confidence there is that the guide assumes no incremental investment in new products, new services, no new acquisitions, et cetera. As you can imagine, our product pipeline is pretty robust, and you shouldn't expect us to sit around and not come out with new products and services over the next several years. But this assumes no incremental investment or new product launches. What we're assuming is 20 to 25% compounded annual growth of revenue over the course of the next 3 years. In financial services, we're expecting that to be 50% compounded annually every single year. What's going to drive growth in financial services specifically is we're really excited about the fact that more and more people are using SoFi as their primary bank. In addition to that, they're deepening their relationships with us through incremental products. One stat that we haven't talked about, but it's worth noting here, is if you look at the last several cohorts of new members that have come onto the platform, approximately 30% of those new members are taking out a second product within 30 days of being on the SoFi platform. So it speaks to our product offering and how our products are better when they're used together, and how we're building that trust and loyalty with our member base. In addition to that, we expect meaningful growth in the deposit franchise. We've been generating over $2 billion of deposits each and every quarter over the course of the last year plus. We expect that to continue and to drive meaningful growth in our net interest income. In addition to that, on the non-interest income side, on interchange, we're seeing really good trends as well. If you look at Q1, we saw $1.9 billion of spend on the platform. That was up from $1.5 billion in Q4 and $1.2 billion in Q3 of last year. And that $1.9 billion of spend on the platform drove $50 million of annualized interchange revenue, which was up 60% year over year. So as we continue to see increased deposits and increased primacy with our money product, you could expect to see incremental growth in interchange. In addition to that, we're seeing really good momentum in our invest business, both on new members, asset net flows, as well as new monetization opportunities. We recently rolled out alts and mutual funds. Those are driving a meaningful portion of our overall net flows this past quarter. So we feel really good about that. In the credit cards business, still tiny. It's only a few $100 million of balances, but we've intentionally slow rolled that business because we wanted to ensure that we have all of the fraud capabilities, and loss capabilities in place. What we are seeing is really good signs that our entry rates, charge-offs and delinquencies are getting to a more meaningful or a better spot for us, where we can start putting more investment dollars behind that business, and be more innovative and start to drive more revenue growth there. And then the last piece that we don't often talk about is our lending as a service business, which, similar to interchange, was $50 million of annualized revenue in Q1. That's a function of, the growth that we're seeing in declines on the personal loans front. So right now, in our personal loans business, we're declining 80% of all applicants that are coming through the funnel. And that's serving as a really good addressable market for our lending as a service business in financial services. As we continue to be cautious and thoughtful about how we're expanding our lending business, you can expect to see our lending as a service business to continue to grow. In addition to that, we'll be rolling out new products in that area and signing up new partners. So net, we're really excited about the growth that we expect to see in financial services. We talked about tech platform, mid-20s% CAGR, and then lending is mid-teens CAGR. On the profitability front, bridging down to GAAP EPS, we expect to generate 30% EBITDA margins by 2026 and 20% GAAP net income margin by 2026. And stock-based compensation is expected to be high single digits as a percentage of revenue. So you put all of those CAGRs and the profitability targets into place, and that gets you to your 55 to 80 cents of GAAP EPS that we're really confident about.
Very impressive. Maybe let's shift gears a little bit more to 24. I'm going to use my favorite word, a credit box. I just learned it this year. So you've been conservative on your outlook for personal loan growth this year. I think last time we met, you mentioned some green lights and red lights. So internally, everything is green. Externally, you're looking at some things that make you want to be more conservative. Maybe we can kind of talk a little bit about the decision to not, open the credit box even more.
Yeah, I think one of the things that's most important, just stepping back away from everything, is 2024 is going to be a year of meaningful growth for us as an overall business. It's going to be a year of increased diversification in revenue, and it's going to be a year of meaningful book value generation. With respect to lending specifically, we are taking a cautious approach for two reasons. One is the broader macro signals that we're seeing out there. Look at rates. There's so much rate volatility. If we rewind back to when we first started setting the plan for 2024, everyone was talking about rates staying higher for a longer period of time. Fast forward 2-3 months when we actually established our 2024 plan, there was 6 rate cuts baked into the consensus. Fast forward another few months, 3 rate cuts. Where are we today? 1 to 2 rate cuts. This morning, rates are rallying 15 basis points off the CPI print. So there's just a ton of volatility with respect to rates. There's geopolitical risk. There's liquidity concerns. So that, coupled with the fact that we have 2 very large segments in our financial services and tech platform businesses that are growing meaningfully and delivering meaningful profit, gives us the ability to be flexible and not unnecessarily grow our lending business when we don't need to and when we can take a conservative approach. So that's why we're doing it. We feel really good about the underlying credit trends that we're seeing in our business, but from a broader macro perspective, there's too much volatility to grow that business more than we need to. What I would say is we're still originating $4.5 billion per quarter of originations across the platform today, which is still quite sizable, despite the conservative approach that we're taking. Now, what would change our outlook on opening up or scaling the lending business? I think the macro would have to change. We'd have to get much better visibility. Rates would have to stabilize. We'd have to have much better visibility into what's happening with fears of a recession, unemployment, et cetera, or rates would have to come down. Our capital ratio, total risk-based capital ratio today is 17.3%. So we have plenty of headroom above and beyond where the regulatory minimum is at 10.5% to scale the lending business if and when we choose to do so. We're being cautious today. If rates come down, that will open up the gates for our student loan refinancing business, and our home loans business, which is really small right now.
And maybe kind of talking about the other side of it, like what is maybe a little bit of an update on the capital market activity, like how do you feel vis-a-vis the loan, the loan buyers?
Yeah, demand is as strong as it's been, since I've been in this seat. We ended up doing $1.9 billion of sales in Q1 of this year. That was the most sales that we've done over the course of the last 2 years. We have more demand than we are willing to fulfill right now at execution levels that are, really favorable to us. So we feel great about the demand. I think part of it is due to, one, the fact that we have been in this business for 11, 12 years, underwriting high quality credit paper, and we're one of the very few providers, if not the only provider, who can provide these types of assets to investors at scale and on a recurring basis. And we've demonstrated that time and time again. I think in addition to that, a lot of folks expect rates to come down over the course of the next 12, 18, 20, 24 months. And buyers are trying to lock in forward flows with these higher yielding assets, as quickly as they can, to take advantage while rates are where they are and while the weighted average coupon of these assets are where they are. So I think that's part of, what's driving the overall demand. We have a robust balance sheet and the capability to meet buyers where they are from a structuring perspective. And feel really good about the demand. Like I said, $1.9 billion of sales just last quarter at really favorable execution levels. And you can expect to see, continued demand and execution going forward.
Thank you. And if I think about your three kind of main lending business side, on the lending side, which is like personal, student, and home, like, what should investors be most excited about if you're looking at like 12 to 18 months in terms of the opportunity on these three subsegments?
Yeah. So I'll start with the one that probably has the largest opportunity for us, which is our home loans business. Right now, our overall market share is less than 0.1% of the overall market. What I would say, though, is we're really really excited about the opportunity ahead of us. We recently acquired a business called Wyndham Capital, which shored up our back-end fulfillment capabilities. Historically, we relied on a partner, but we realized how critical it was to own the back-end fulfillment capabilities and technology. That's now established, fully integrated, so we're ready to go. In addition to that, we recently rolled out some new products with VA loans, with home equity lines of credit, with home equity loans, which will serve and help to drive incremental growth in that business. So even despite where rates are today, we expect to be able to start taking meaningful share as a result of having our fulfillment capabilities shored up, as well as, all of the table stake products out there. Another interesting stat that's important to note is that only 1% of all SoFi members who have a mortgage are taking the mortgage or have the mortgage with SoFi. So we have a huge installed base of our own existing members that we don't actually have to pay meaningful marketing dollars to go out and acquire or originate to, that will serve meaningful growth for us going forward. On the switching gears to student lending, in-school loans is a really good opportunity for us. It's a $12 billion origination opportunity per year in the market. You saw a few key players drop out recently, so that should serve as a meaningful tailwind for us. It's a really small business today, but we're making really good strides. We're in 1,000 schools right now, which has taken some time, but we're there, and you can expect that business to continue to grow. Student loan refinancing, obviously the rate environment as well as some of the uncertainty with the Department of Education is driving where originations are today. We're right around $650 to $700 million of originations. You know, once we get through the election cycle, and if rates drop, there's meaningful opportunity to grow that business. And then on the personal loans front, we target, you know, prime borrowers who have average FICO scores in the 750 range with average incomes of $160,000. We have about a 10% market share of that business in our credit box, so 680 and above. We've grown that market share quite meaningfully over the course of the last few years, and there's a ton of headroom to continue to grow it. We're obviously taking a conservative and pragmatic approach to that business, so I wouldn't expect that to grow meaningfully. But there is meaningful headroom, and we have the capacity to be able to do that from a capital ratio perspective if the macro changes.
Got it. And maybe we're almost out of time, so maybe one last question on my end. There's been some I would say some discussion around the ability to maintain the 7 to 8% life of loan losses and the confidence around it. Can you maybe touch a little bit about the, I guess, the lumpiness in NCOs and how that mechanism, or I think there's been a lot of misunderstanding about timing and duration, and we're certainly getting a lot of questions about it from investors. So it would be great to maybe have some clarity on that.
Yeah, absolutely. So what I would say is what gives us confidence in that 7 to 8% life of loan loss level is we have over a decade of experience in underwriting high quality credit. In addition to that, we're seeing really favorable trends in some of our more recent cohorts. So I mentioned this during our Q1 earnings call, but just to provide a little bit of incremental detail, if you look at our Q1 through Q3 cohorts of 2023 and compare that to Q3 2022 cohort at similar levels of unpaid principal balance on the balance sheet, you would see that our losses of recent vintages are 20 to 40% better than Q3 2022. If you take that a step further and rewind back to 2017, the last time we saw life of loan losses that even came close to 8%, it was still below 8%, but nonetheless, it was the highest cohort that we had. Our losses, again, comparing to similar levels of unpaid principal balance remaining on these loans, are performing 40 to 50% better than 2017 levels. So we feel really optimistic and comfortable and increasingly confident in our 7 to 8% life of loan loss guide that we provided, and we're really optimistic about the underlying trends that we're seeing. In terms of the lumpiness on the NCO rate, what I would say there is there's a ton of things that drive the net charge-off rate on a quarter-to-quarter basis. It's based on new originations. It's based on sales that we do in the quarter. It's based on runoff on the existing book. It's based on the tenor or the term of the loan that our borrowers are taking out at a given point in time and what that looks like in the overall portfolio. One of the things that we're seeing right now is that given where rates are and the expectation that rates are going to come down, people are taking out shorter term loans with the expectation that they can refi, you know, in 1, 2, 3 years when rates start to come down. So we're seeing a shift towards shorter duration loans being taken out, which is resulting in losses happening at an earlier stage in a loan's life cycle, which is creating some of this lumpiness that we see in NCO rate as well. So I think some of those are things are the factors and why it's important to understand the key drivers. To your question about, you know, how we should think about NCO versus CDR, what I would say is they offer investors and readers of our financials two different things. The NCO rate is backwards looking and reflects the losses of the collateral that just charged off and can be impacted by all the things that I just talked about. The CDR is a representation of what's remaining on the book and the losses that are expected to happen over the life of the loans on that book if a buyer were to buy those loans today and hold them until maturity. So they're two different things. There's a lot of lumpiness in the NCO rate, but at the end of the day, we're really excited about the trends that we're seeing from a entry rate, delinquency rate, charge-off rate on, vintages since the beginning of 2023.
Well, thank you, Chris. I'm actually planning to send more money to SoFi. So
we appreciate your
experience. So thank you.
Thank you very much. Really appreciate
Thank
it.
you.